When a market compresses for an extended period, it is not resting, it is deciding. Sustained contraction following expansion builds directional pressure. Bitcoin is trading inside a defined corrective range with multiple timeframes aligned. Structure has not failed, but weakness is present. The resolution from this compression will be mechanical. If confirmation develops, the next phase will unfold from here. Bitcoin is compressing beneath $66,500 while holding above $60,000 structural support. Volatility has contracted following prior expansion, and higher timeframe structure remains intact. If acceptance builds below $60,000, downside rotation toward the $28,000 to $29,000 Fibonacci cluster becomes structurally available. Invalidation occurs only on sustained reclaim above $66,500, keeping this level central to directional commitment and defining the current range as the decision point for the next expansion phase. Our job is not to sensationalize, and it is not to forecast. Using Bitcoin technical analysis, we examine the current structure and identify both price action strengths and weaknesses. Today, we examine the weakness side of that equation, the possibility that the current correction deepens further. We will define the confirmation level, the structural reference, and the invalidation level. You draw your own conclusion. Welcome back. We are price action traders. Every day, our focus is just one chart, the Bitcoin chart. That singular focus is what makes us Bitcoin technical analysis specialists. Every day, we answer 5 key structural questions for you. Where are the key price zones? Are the timeframes aligned? What is volatility signaling? What are the macro markets telling us? And what must change to revise Bitcoin's structure? Today, all 5 point in the same direction. We begin where we always begin, the higher time frame. The yearly chart has not changed. The upside structure that has governed Bitcoin's price since the 2022 low remains intact. No bar, no close, and no sequence of price actions so far in 2026 has structurally invalidated that picture. What we are experiencing is a corrective phase operating beneath an intact higher time frame trend. The higher time frame is not broken. The lower time frames are under pressure. That distinction shapes everything that follows in today's analysis. The monthly and weekly timeframes have been in a corrective phase since February 2026 and remain in that state. Week 9 closed on 1st March 2026, bearish, closing at $65,852 against an open of $67,639. But it is the monthly time frame that carries the most weight in this analysis. We track how each monthly close finishes relative to its open. It is one of the most reliable indicators of who is in structural control at the higher time frame. What the data is showing us right now is a sequence that demands attention. October 2025 closed below its open by $4,578. November 2025 closed below its open by $19,072. December 2025 closed below its open by $2,832. January 2026 closed below its open by $9,015. February 2026 closed below its open by $11,695. 5 consecutive monthly closes below the open. Each month, without exception, sellers have controlled where price finished. That is not a single event. That is a pattern of sustained bearish pressure playing out at the highest time frame available on this chart. And it is the structural context in which today's downside analysis sits. There is one further statistic that contextualizes the scale of this corrective phase. The yearly open sits at $87,626. The 1st March close printed at $65,852. We are currently $21,774 below the yearly open. 60 days into 2026, and Bitcoin has surrendered nearly $22,000 from where the year began. That gap does not predict direction, but it defines the structural pressure the market is carrying into this compression. Any buyer stepping in here is doing so against the weight of 5 months of consecutive bearish monthly closes and a significant distance from the yearly opening price. Now we examine what the Fibonacci measured moves are telling us about where price may cluster below $60,000 if the current correction deepens. We have drawn three independent Fibonacci sequences, all terminating at the same point, the Bitcoin all-time high of $125,761 on 6 October 2025. The reason we use three sequences rather than one is confluence. A single Fibonacci level carries weight. Three independent sequences converging at the same region carries significantly more. The first sequence measures from the COVID structural low of 13th March 2020 at $3,718 to the all-time high of $125,761. This covers Bitcoin's price action across 5 years. The Fibonacci retracement of that complete move produces levels that define the macro structural boundaries of this cycle. When price approaches these levels, participants with longer-term positioning are aware of them. The second sequence measures from the November 2022 low to the same all-time high. That low was the floor of the previous bear market, a period following the speculative excess of the 2020 to 2021 cycle, where perceived easy borrowing conditions fueled aggressive participation and drove Bitcoin to unsustainable valuations. When quantitative easing was tightened and liquidity drained from risk assets, Bitcoin fell sharply to that bear market low. The Fibonacci retracement drawn from that low to the all-time high produces a second independent set of levels. Three sequences, three different time origins, all mapped to the same destination. When three independent Fibonacci sequences converge at the same price region, that convergence becomes a Fibonacci cluster, a zone where multiple layers of measured support overlap simultaneously. The Fibonacci support cluster these three sequences produces sits between $28,051 and $29,161. Three independent calculations creating a tight price zone of just $1,000, sitting just below the $30,000 psychological round number. The Fibonacci levels are not forecasting a move to $30,000. They are identifying where structural support may sit if the current correction deepens beyond $60,000. Context, as always, is everything, and as we always say, structure defines context, and context defines edge. The confirmation trigger for this downside risk is defined as the violation of the February 6th low at $60,000. As covered in yesterday's equilibrium video, link in the description, the fifth and sixth bars have been the two controlling bars of this entire corrective phase. Every bar since has closed within their combined range. A sustained break below $60,000 would break that two-bar dominance and signal that the corrective phase has transitioned from consolidation to directional expansion. Bitcoin's volatility has gradually creeped higher, but so far remains contained. The daily ranges over the last 3 sessions have been expanding in a measured fashion. $2,292 on the 26th of February, $3,326 on the 27th of February, and $4,592 on the 28th of February. The February monthly close. Week 9 produced a weekly range of $7,501. The direction of volatility expansion is upward, but the total increase across these sessions remains under $2,500, measured expansion, not directional commitment. The market is beginning to breathe more freely, but has not produced the sustained range expansion that would confirm a break in either direction. The compression is intact. Volatility will tell us when that changes. From a macro perspective, 2 developments this morning carry direct relevance to the Bitcoin price picture. First, the US dollar index. In a previous video, we identified $98 as the ceiling the dollar index had been pressing against without conviction. That ceiling has been broken this morning. The US dollar index has rallied above $98 in the Asian session on 2nd March, with a move that carries more force than the previous tests of that level. The relationship between the dollar index and Bitcoin is well established. A strengthening dollar historically creates a headwind for risk assets. Capital that flows into dollar-denominated positions tends to flow away from Bitcoin and other risk exposures. The caveat is important. The Asian session is still active as we record this. London opens with European institutional participation, and New York follows with the deepest liquidity in global markets. Whether those two sessions confirm the dollar index breakout above $98 or reject it back below $98 will determine whether this morning's move is a genuine regime shift or an Asian session overextension. We observe, we do not conclude on partial sessions. The second macro development is gold, and this morning's move carries a different kind of weight to the DXY story. Gold has opened with a gap up and a kicker candle. A kicker candle is a sudden, strong, directional move that gaps away from the prior session, typically driven by an event rather than gradual price discovery. This morning's catalyst appears to be geopolitical. Reports of a sustained military operation involving both Israel and the United States against Iran have introduced a risk-off environment into the Asian session. When geopolitical risk of this magnitude enters the market, institutional capital historically rotates towards safe haven assets, and gold is the primary beneficiary of that rotation. Gold is approaching the early 2026 high recorded on 29 January at $5,626. A sustained break and acceptance above that level would signal that gold's uptrend is resuming with institutional momentum. In the context of geopolitical stress, that signal would suggest safe haven demand is not a one-day event. For Bitcoin, a gold breakout under these conditions, combined with a dollar index breakout above $98, represents a macro alignment that has historically increased downside structural risk for risk assets. Capital preservation takes priority over exposure when both the dollar and gold are moving higher simultaneously. From Bitcoin's perspective, the Asian session this morning is leaning bearish. The price action is not producing the buying response that would suggest the market is treating the geopolitical news as an opportunity to accumulate. Instead, the lean is toward risk reduction. As always, the London Open and New York session on 2nd March carry the institutional weight that gives any directional signal its validity. We note the lean, we do not act on the lean alone. The argument for further downside correction is building across multiple independent inputs. The monthly time frame has delivered 5 consecutive closes below the open. The dollar index has broken above $98. Gold is gapping higher under geopolitical pressure and testing its early 2026 high, and the Bitcoin triangle structure from yesterday's analysis is compressing toward its termination window with volatility beginning to stir. Each of these inputs viewed in isolation is a data point. Viewed together, they represent a convergence of pressure on the downside of Bitcoin's current structural range. Confirmation requires violation of the February 6th structural low at $60,000 on a closing basis. Until that occurs, the current structure remains a corrective phase within an intact higher timeframe uptrend, not a confirmed breakdown. Invalidation of the downside case is equally clear. Strong, sustained closes above the equilibrium balance point of $66,500 with a structural push toward $80,000 would neutralize the downside argument and shift the framework back toward the upside. For full context on the equilibrium level and the triangle structure, see yesterday's video linked below. 2 scenarios, 1 structure. The trigger is $60,000. The invalidation is $66,500. We monitor, we do not anticipate. Discipline over prediction. We publish every day at 7 a.m. EST. If today's BTC analysis added clarity to your view of the market, consider subscribing. You will not miss a daily update. Comment below, is $60,000 the line you are watching, or are you already positioned for a deeper correction? We read every comment. The market will have more to say tomorrow. We will be here to read it. Until then, look after yourself.